You know that feeling when markets start to wobble and you wonder, should I maybe move some of my money to cash? Maybe wait for things to settle down before investing again? It's one of the most common instincts that investors can have, and also one of the most damaging. Here at Towerpoint Wealth, we call this the myth of successful market timing. And we believe it's next to impossible to consistently do. Despite how logical it might sound, trying to perfectly predict when to get in or out of the market almost always costs investors far more than it helps them. So stick around, because in today's video, we're breaking down why time in the market, and not necessarily timing the market, is what really can drive longer-term success. Hi, my name is Joseph Eshelman. I'm the president of Towerpoint Wealth. We're a fully independent fiduciary wealth management firm headquartered in Sacramento, California. And here at Towerpoint, we help clients build and protect lasting wealth through coordinated, strategic financial planning, not last-minute moves, market tips, or guesswork. So let's start with what we actually mean by market timing. Market timing is when investors try to stare into their crystal ball and predict when the market will rise or fall, buying before it goes up and theoretically selling before it drops. Sounds great in theory, right? But here's the problem. You don't have to be right once, you have to be right twice. So what I mean is you have to correctly guess when to get out, and you also have to be correct on when to get back in. And as anyone who's watched markets for a while now knows, that's a game no one wins consistently. Most of the time, investors who try to time the market end up selling low, then just kind of sitting on the sidelines while prices recover, and then buying back in after the rebound when prices are higher. So that's not the strategy they often think it is. That's just a stressful loop, and it's literally selling low and buying high. The truth is, markets don't simply move in predictable patterns. They react to everything: earnings, inflation, interest rates, geopolitics, and sometimes just investor psychology. And because the biggest market gains often come in sudden bursts, missing just a few of those days can crush your overall returns. For example, if you miss the 10 best days in the market over the past 20 years, your overall return would have been cut in half. That's the real cost of trying to time your way through market volatility. And then there's the emotional side of investing. Fear, greed, reactions to the headlines, they all push investors to act in ways that feel smart in the moment, but oftentimes hurt in the longer run. So when things look bad, we want to sell. It feels natural. And when things look good, we want to buy. And while it's not the most rational investing psychology, it is human nature. So now let's flip the script, and instead of trying to outsmart the market, what if you just simply stayed in it, stayed invested? That's where time can become your greatest ally. The longer your money stays invested, the more it can benefit from compounding, earning returns on top of returns, and over time, the effect becomes exponential. Volatility becomes less frightening when you zoom out a little bit. Every dip, every correction, every bear market in history has eventually given way to recovery and new highs. It's essential to remember that while painful, these corrections, these pullbacks, have always been temporary. But you only benefit if you're still invested in the market when that recovery happens. We've seen this time and time again with our clients. Those who stay disciplined, diversified, and invested tend to outperform investors who try to wait for the perfect moment. So how do you actually put this into practice? Well, it starts with a solid longer-term investing philosophy and strategy. That means spreading your investments across different asset classes like stocks, bonds, alternatives, and cash so that you're not relying on any single market movement. Now, importantly, it also means systematically rebalancing your portfolio, trimming what's gotten too big and grown too fast, and reinvesting where there's more opportunity and prices are lower. And being mindful of taxes is essential, managing gains and losses in a way that keeps more of your capital working for you and less in Uncle Sam's hands. Finally, it's all about consistency. Making regular contributions, dollar cost averaging, and staying invested, and just working to tune out the noise. Because over the course of decades, discipline beats prediction. At Towerpoint Wealth, our philosophy is simple. Planning matters more than trying to predict. We don't chase headlines or try to outguess the market. We help our clients build plans designed to endure whatever might come next. So if you're wondering whether your portfolio is built for time in the market, or if you're still chasing the timing game, we'd love to talk. Schedule a complimentary 20-minute Ask Anything conversation with our team. We'll help you see where you stand and how a disciplined, longer-term plan can help you reach your goals without the stress of trying to predict the next market move. Thanks for tuning in, and don't forget to like this video and subscribe to our Towerpoint Wealth YouTube channel for more strategies, insights, and financial guidance from us here at Towerpoint Wealth. Until next time.